Was the tax man unfriendly this year? Are you looking for ways to lower your taxes? Stay tuned. Welcome back. In this video I've got 7 tips to help you lower your taxes in 2024. And so let's go ahead and get started with number 1. Update your W-4. This seems simple and I don't know why it gets missed so much. But I really feel it's important because it's the one that just gets missed year after year and people don't understand why they owe taxes every single year. So why do you? It's because most likely your W-4 wasn't filled out correctly. What are some of the causes for that? Well, one of the most common is because we have multiple jobs, or we're married and we have our spouse as a working spouse. Now, why does this happen? The reason is the tax tables are designed for people with one job. And so often they don't understand what's happening. There's a piece of the W-4 that's almost always missed, and it's page 2 that has schedules, but nobody wants to go through all that. So what's really happening is your income, whether it's you or your spouse, doesn't matter which one, that's what it's calculated on, but it doesn't know that your spouse or that you have a second job, and it's stacking that on top of your income, and it doesn't know to do that. So think about it like this. If I'm married and I have a standard deduction of, let's just say, $27,000, $29,000, depends on the year, it gets indexed every year, it doesn't matter, but I have a standard deduction and I have a child. Well, if I fill out my W-4 and say I'm married with one dependent, or in this case 2,000, the way the new W-4s are filled out, it assumes that I have that. Well, what if my spouse, or what if I own the other job, I fill it out the exact same way? It doesn't know that I've already used all of that with another job. And that's why we end up short. So if you need help with that, I made a video last week that goes over how to go through a W-4 and recalculate it. Super simple, but it's very critical, and I've helped so many people over the years get this fixed, and it just takes the stress out of tax season. If you're like, I don't understand, I told them to take out another 50 and I still owe. Well, that's why. The tax tables aren't meant for multiple jobs unless you take the extra step to do the calculation. And my other video will make that easy for you and show you how to do that. So go ahead and take a look at that if that's something you haven't done. And it's just a good idea to go through that estimator every year and just make sure. But a quick tip on that, think about it like this. If you owed $2,000 and you get paid every 2 weeks, divide that by 26 pay periods and just tell your employer to hold that out of your check every pay period, and it'll be fixed. It really is that simple, but if you want more, the other video will take care of that. Now, I understand this doesn't save you on taxes, but look, some of it's just peace of mind and knowing that things are okay. So it didn't really lower your taxes, but it did lower your stress, and that's real. All right, number 2 is contribute to your 401k, 403b, simple, whatever your employer has. I just don't understand why people don't at least take advantage of the match. What if I told you, look, if I can show you how to double your money immediately, are you interested? Almost everybody is going to say, yes, I would love to double my money. Yet how many people don't take advantage of the match at their employer? So many plans are a dollar for dollar match for the first 3%. Others may be a 50% up to 6%, still getting back to the 3%. And there's a lot of other ways of doing it. But if your employer is going to give you $1 for every dollar you contribute, you're doubling your money. And on top of that, let's say you make $100,000, and so you put $3,000 in. All right? You're in a 22% bracket or 24% bracket, plus your state, let's just say it's 5%, because that covers most states, or 4 to 6. I know some are higher, some are lower, some have none, whatever. For this purpose, it's just 30%. If I contribute $3,000 and I'm in a 30% bracket, I'm saving almost $1,000 in taxes. So not only is my employer giving me $3,000, I'm also saving $1,000 in tax. So I put in 3, they give me 3, I save $1,000. Why are you not doing this? Let's be honest, what's going on? Don't let this slip you by, and year after year after year, think of how much that's going to add up to when you get ready to retire. So hopefully anybody watching this video, you're going to go to work tomorrow and say, you know what, it's time. I'm going to actually take responsibility for my future, and I'm going to start right now, and I'm going to take advantage of that match. Your employer is trying to give you money. Really? Let's do this. Okay, you say that the market's going to crash or it's going to drop. Well, let's just think about that for a second, right? We're already put in 3 and we're at 7. The market can go down over 50% and you still have just as much money. No more excuses. Do it. Okay, on the last one we saved almost $1,000. But let's take that another step. So my next one is, let's go ahead and max out the 401k. You want to save money, you want to save taxes, you say there's no tax breaks left for you as an employee, but you're not taking advantage of this. Not only are you not getting tax savings, but you're also stealing from your retirement, if we're being honest. Let's max it out. Now I know not everybody can, budgets are tight, I get all that, inflation. But if you can, max out your 401k. So how much will you save? Well, what tax bracket are you in? I understand if you're in a lower bracket, you probably can't afford to max it out. But if you are in a higher bracket, you probably can. So how much can you do? Well, if you're married, you could do $23,000. And if you're over 50, let's get it together, guys. We need to get this piled in there. Retirement's coming quicker than we want to admit. You can add another $7,500. So what happens if you're in a 22% bracket? Again, same kind of a concept. So we can put in 23 and 7. So that's $30,500. And you're in basically a 30% bracket between federal and state. That's $10,000. That's a true tax savings of $10,000. And this video is free, but you just saved $10,000. And if your spouse does the same thing, $20,000 of pre-tax money that is now ready for you when you retire, and it can grow for however long you have left. Now, maybe you don't have that much, but let's say you're in the 22% tax bracket, okay? And you're just barely in it. Maybe you're $12,000, $15,000 into the tax bracket. Then maybe you and your spouse should at least contribute enough to get from that 22% bracket back down into the 12, right? Or whatever bracket it is. Let's at least try to get back down into that next bracket and save money at that higher level. That can have big tax savings for you. We're planning for our future. You're going to have a better retirement. And so this is good plan. I mean, do it. Let's do this. I understand some of you are saying, well, what about a Roth? Look, I love a Roth. That's a really good strategy. This one's about saving taxes today. We'll do other videos about saving taxes in the future, and I should do one or should I do both, or how much should I have in each bucket. Fantastic conversation. But right now we're just trying to save taxes in 2024. And this is a way that you can do that. So far, that's a big tax saving. Now next, this is one that a lot of people don't think about, and it's dependent care benefits. Now for a lot of you, you may already missed out the opportunity to go ahead and enroll, but I don't want you to miss out the next time you have the opportunity to do this with your cafeteria plan. You can put in up to $5,000 towards your dependent care benefits through your 125 plan if it allows that. And if it does, it's really big, because what happens is you get a $5,000 pre-tax contribution. And once again, what if we're in that 22-24% bracket plus 5% state? 30%. We can save 30% on $5,000. But wait, it's better than that. It's also pre-tax for FICA. FICA and Medicare. So it saves another 7.65% on that. So if you're like in that 24% bracket plus 5, so we're 30 plus the 7, we're almost at 38%, or maybe we are 38%. I probably should have done this on paper before I got on a video camera, but you get the point. 38% savings on $5,000. Why are you not signing up for this if it applies to you and you've got your child going to daycare? Well, I get the credit on the tax return. Whoop-de-doo. That's maxed at $3,000, and if you have this kind of income, that's only a 20% credit. Your max credit on the tax return is $600. Would you rather have $600, or would you rather have 38% of $5,000, right? So make sure we take advantage of this. This is one that gets missed a whole lot, and I don't want you guys to miss that. Make sure we're taking advantage of the dependent care benefit. Now, it's only $5,000 total, right? We can't do $5,000 for you and $5,000 for the spouse, so don't make that mistake. But this is a really, really good tax break that so many people miss. Okay, cruising right along. Number 5, HSAs and FSAs. I love the HSA, and FSAs are cool too. Depends on your employer, depends on your health care plan, on which one you qualify for. But an HSA, you can contribute up to, what's my number? $4,150 if you're single, or $8,300 if you're married and 24. Once again, think about this. 24, basically just 30%. That's the whole thing. Pay attention to this. 30%. I just contributed $8,300. And there's a lot of things that can qualify to be used on this HSA. Your eye appointments, your dentist, your chiropractor, probably some therapy if you got some mental health therapy stuff that you're doing. These are ways that you can take these expenses and make them deductible. And not only are they eligible, but a 30% tax break on up to $8,000. So you actually get to make them cheaper, right? 30% less on $8,300. Once again, real tax savings. $2,500 roughly, if we did 30% of $8,300, is the tax savings that you would get by taking advantage of your HSA. You're already spending the money, right? And the nice thing with an HSA is it rolls over from year to year to year to year. So if you didn't use it all, it's there in the future. Basically, it's another retirement plan vehicle that the IRS has given you so that you can contribute there. So not only do you have the 401, you have the HSA, and a lot of people use it that way. They're healthy. They don't need the medical expenses covered necessarily, at least not yet, but they're building up another bucket of money for when they need it or when they retire. And this is just good planning. It's something I want you guys to take advantage of. Now, if it's a FSA, remember FSAs are use it or lose it, so we need to be a little more intentional about how much we put into one. We got braces coming up, great. We got shoulder surgery, great. Eyes, LASIK, whatever it is you're wanting to do, but let's start being intentional about our taxes and our planning, and there's a lot of opportunity if we'll just take it. Now, the sixth one is not really a tax-saving tip, but a warning. So often I will see somebody who went and bumped up their 401k withholding, or they bumped up their HSA, or one of these other things that I've talked about. And then when they file the tax return, they're upset because they still owe taxes on the tax return. And the thing is, we lowered our taxes. We really did. A lot. But the problem is, just like that multiple job scenario that we talked at the beginning with the W-4, all that stuff was pre-tax, and so the W-4 just held out on a lower amount. So it's not going to change the amount you owe significantly on the tax return. It's going to change the total amount you pay. It's going to save you a lot of taxes, but it's not going to change what we owe on the tax return. So that's why that first point is so important, Let's get that W-4 set correctly, because otherwise you're going to do all these things. We're going to save a bunch of taxes. We're going to see our taxes go from 20,000, man, if we do all these, maybe 10. I mean, it's going to drop it a lot, but the withholding will also drop because the W-4 is just adjusting for the taxable income. So make sure, once again, go back to number one, get that W-4 right. That's why I listed it. It's so important to get our W-4 right with our employer, and make sure HR gets it. So often people said, I turned it in. Well, guess what? Big boy time, this is your tax return. If you put in a W-4 change and your net check did not make any difference, then guess what happened? Nothing. So let's take some responsibility when we turn it in to make sure that something changed. And on the W-4, one of the things that happens there a lot of times is we're getting a big bonus. So we change it to exempt real quick, and then we forget to switch it back. So if that's you, switch it back. Don't make a mistake. And my last point, number 7, is if you're going to take money out of a retirement account, especially if you're going to take it out early, but anytime there's a major life-changing event, make sure you talk to your accountant. Your financial advisor is just going to hold out whatever you said. At least a lot of them will. Or they're going to do defaults of 10% or 20%. And especially if you take it out early, they forget about the fact that there's a 10% early withdrawal penalty. Now, one, that's a whole other video. Don't be taking money out early unless you absolutely have to. There's probably a better way. Work with your accountant on that, or your financial advisor. There's probably a better way to do that. But if you're going to take money, get your accountant involved, because I see it every single year. Well, they said they held out the taxes. Well, great. They held out the taxes at 10%. Guess what? It was an early withdrawal, and you're in a 24% penalty. You owe a bunch of money. So please, if you're going to do any kind of a life-changing event where you're going to start changing your income, you're going to start taking money out of your retirement, include your accountant in the conversation. Yes, there's going to be a cost to go see them. It's going to be a whole lot less than that big surprise when you've already spent the money and now you owe Uncle Sam a lot because you thought the right amount was withheld. I see it every single year, and not just once, a lot of times. So please, my last point, if you're doing a big life-changing event, you're taking a lot of money out of your retirement, don't assume that the right amount is withheld, because it's probably not. I've just too many times. So that's it. I hope you found this helpful. If you did, please subscribe. I'll try to keep doing this more and more for you guys, and want you to be the most educated when it comes to taxes that there is. Have a wonderful rest of your day.